Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com and President of Verified Investing Education, is back with us to discuss the principles of trading. Gareth, welcome back.
Hey, David, it's so good to be back. Thanks for having me.
Thanks for hosting you as always. Now, we've done a number of interviews together regarding your outlook in the markets, both short-term and long-term. We will revisit your longer-term outlook for Bitcoin, gold, and stocks today, but I want to just revisit some of your philosophies of trading. You and I did a live event early in the summer, an hour-long event focusing on just this theme. Let's revisit this for our audience here. Your top 3 trading principles to becoming a master trader.
Oh, wow. So to become a master trader, you have to get your own discipline under wraps, meaning that the keys are going to be following strict rules. As soon as you kind of go outside of your box of your disciplines, that's where the market ends up eating you alive. So always remember, discipline, personal discipline when it comes to trading is paramount to success. The second thing is understanding human psychology. And this comes in where, many people were buying Bitcoin at 65, 67, $69,000. And obviously that was the wrong time to do it. They were doing it because they saw everyone else doing it. One of my biggest principles is when you see everyone else doing it, you do not do it. In fact, step back, and it might even be a good shortable opportunity if everyone is buying an extended chart that's making new all-time highs continually. And lastly, it's the charts, right? The charts are basically representations of human emotion. Remember, buyers and sellers are the ones that are buying. A chart goes up, selling, the chart goes down. So it's representing millions, if not, multiple millions of people in a market. And therefore, you're reading their psychology. You're reading their greed and their fear. And the charts are like a puzzle. Every piece, every time you get a new piece of that puzzle, it tells you a little bit more to do or what the chart is likely going to do. And always remember, it's all about probabilities. You want to be the casino, not the gambler.
Okay. But what if people are crowding in because there's momentum? Wouldn't you want to ride that wave?
No, I'm not a momentum trader. I think a momentum trader is a gambler. And what I mean by that is that where in the momentum cycle are you? Now, if you happen to be at the very early point when there's not a lot of hype on something and the momentum is just starting, fantastic. To me, that would be a bull flag breakout just beginning. You can ride that wave. But by the time there's that crazy momentum where something's going parabolic, you don't know if you're entering at the very end of it or the middle point or 3/4 through. And to me, that's a risk that I'm not willing to take with the money that I continue to make, and it's hard earned money. So I always say this to people is, you're making your dollars, we're working hard to make money. You don't want to take risks with it unless it's a high percentage probability you're going to be successful.
Right. But you and I talked about trading volume quite a bit. Let's revisit this one more time. How do you read volume? Let me give you a scenario. Suppose you have a stock or a Bitcoin. Let's take a stock, for example. It's kind of been flat, trading range bound. All of a sudden, you see huge volume. The price hasn't moved yet. What's your first question that you're asking yourself?
Yeah, absolutely. And that would be something that would catch my attention because that's usually institutional volume, right? So if price isn't moving yet, but you're seeing block buys go off, and really let's be fair, that's probably one of the only ways you're going to get some big volume without price moving. But if blocks are going off, 100,000 share blocks, a million share blocks, that's telling you that some institution is loading the boat there. And again, the next step would be is, okay, look at the chart. If it's going sideways and it's been very quiet, has it created a bull flag? If it has, you have to jump on top of that and you have to ride that.
ChatGPT is taking the world by storm. It's a language bot, but we can extend that to a lot of other applications. Should it progress and advance from here? I'm sure it can. This technology has a lot of uses. Let's suppose it has applications within finance and trading. Are you at all aware of the fact that, or perhaps are you concerned about the fact that an AI could become a very good trader?
I think that is a possibility. But I think that again, the institutions already have that edge. A lot of the algorithms. In fact, I would almost guarantee that a lot of the hedge funds, the biggest hedge funds and institutions, are already trying to incorporate it to see if it can work. So I do think that's a concern. I think that's something the regulators are going to have to look at. Like, do you kind of have a monopoly in terms of institutional investors using some technology like this that the retail crowd does not have at their disposal? And is that, or should it be legal? And I would dare say that again, it's all about keeping an even playing field for all investors. And
Mhm.
obviously, you have institutions that they have information slightly quicker than the general public because we do not tune in quite as much as they do. But overall, they can still buy and they sell. Now, if you get an algorithm that's an AI and can actually start gaming things, then that could be problematic.
Yeah, the institutions have their own bots and algorithms, and I think for the most part, they're pre-programmed to follow a set of rules,
Right.
either set by the engineers or the traders themselves, working alongside the engineers. Now, here's a new bit that may be somewhat controversial. Perhaps this computer or the software could teach itself how to trade, program its own rules, beat the market that
Right.
way. Is that possible?
Well, so it's, I mean, that's what AI is supposed to do, right? It's supposed to learn and adapt. And I think the biggest issue there is, right? I mean, we know the Terminator movie and how it kind of brought again around Armageddon, but the idea is, could this bring financial Armageddon? What if all these algorithms, what if there's a bunch out there and all of a sudden they start learning things and all of a sudden the markets start to drop and they're learning, they say, oh, well, this looks like a crash. Let's all dump at the same time. Does it then create a potential for a stock market crash? And I think that's where we have to be very, very careful. There needs to be safeguards put in place. There needs to be rules. And this is the new frontier. I mean, whether it's, Neuralink, right? Something that an Elon Musk is working on that could make someone much more advanced than they normally would be, or algorithms that can trade and really, squash the little investor. It's definitely something the regulators need to be on top of right away.
And how would you respond to I guess the statement that human will always be better than an experienced human trader will always be better than a computer program based on a number of emotional factors? Would you agree or disagree with that statement?
So I'm a big fan of acting like a robot. Like if
Okay.
a trader or an investor can be robotic, right? Then they're going to have an advantage. The
It's
one-time
interesting you
investor.
say that. It's like you're trying to be, you're trying to be robotic with your trading, but then the engineers are programming robots to be more like people. I just find that ironic. But yeah, anyway, I'll let you continue.
That is actually very ironic. But the key is this, is that as a trader, the one time I get into mistakes, and I've made plenty of mistakes, and I want people to understand this, is that, by no means did I, start out a great trader. I had to go through years of learning, losing money, making bad decisions. And if I look back at those decisions, there were key things that I did wrong, and they generally all stemmed from me getting emotional. It was either something was running up and I felt like I was missing out. I had that FOMO, so I jumped in. And of course, like everyone else, you jump in, generally it's going to be towards the all-time highs or the high pivot of that before it sells off. And the same thing on the downside. When something's crashing, instead of looking at the chart and being robotic and saying, okay, this is support, this is where it should hold, I was panicking and I was dumping at the absolute wrong time. So believe it or not, you actually want to be more robotic. You need to control your emotions as a trader and look to the logical chart statistics, the probabilities.
Okay, and in terms of how AI could be used by the general public, perhaps it could be an additional tool for educating traders and perhaps for new traders to use to assist them with their trades. Do you see this being a complement to your tool set?
Yeah, I mean, you get into some interesting things where like I'd be intrigued by some sort of method where I could be, kind of just talk to an AI, right? If I could talk and say, "Hey, buy 1,000 shares of Microsoft," or do this or do that, and if I had trust that that would actually do it, or kind of direction, as long as it was under my control, I think that would be very beneficial. And then also AI potentially, mapping out potential moves in a market, right? So show me the five most probable moves of Tesla over the next 1 week period, and it'll kind of gauge those things. And so there's a reason. I mean, there's a way it could bring really valuable information to me
Mhm.
as a trader. It's just once you get into saying, okay, let's let this bot go trade on its own and learn and do whatever it wants to do, that gets a little scarier when you're dealing with a financial system of hundreds of trillions of dollars. I mean,
Right.
again, we all know what happened during the Great Recession. You kind of throw this to the AIs, who's to say where it's going to end up?
So let's think like a robot now, Gareth. If you were to program a set of rules, which I know you do, for yourself as a trader, let's take a look at some of these rules that you have for yourself and how you would use these rules to evaluate the future. Because after all, predicting stocks, charts, it's all about examining past patterns or past data and extrapolating. So what are some of the key data sets that you're looking at when someone gives you a chart, when you pull up a chart, and the first things you look at before making a decision on whether or not to buy or sell or hold?
So for me, number one is, and I go through this with my day traders all the time, is that we look at volume. And the reason I look at volume is that if something does not have a lot of volume, then it adds additional risk to your trade. So as a trader, your goal is to minimize every risk possible. And by the way, you're not going to be able to get rid of all risk. Investing is risky, but the point is you don't want to take dumb risk. And when there's very little volume, it means that one seller, let's say I'm buying XYZ, it only trades 100,000 shares a day, and I'm picking up 10, 20,000 shares. What if one seller had a bad day and this person that owned it was like, all right, I'm going to dump my 100,000 shares. That 100,000 would manipulate and drop that price significantly out of my control. So the first thing I look at is volume, making sure it's extremely liquid. No individual should have power to change the chart pattern that I'm looking to trade. Another key principle would be, is there action here? If there's no action, if a stock is trading sideways and not moving, why am I going to get involved in that? My goal is to be in and out quickly as a day trader, even as a swing trader. I want to find a level. I want to buy that level as the stock is collapsing into it, and then watch for that snapback bounce off of that technical support. So again, as a trader, it's a very different mindset than a long-term investor. Long-term investors are focused on fundamentals. Fundamentals are key. You want to go long, so stock makes money, they pay a dividend. Fantastic. Over 10, 20 years, you'll do fine. For me, I couldn't care about dividends because I'm in and out of stocks so quickly. And same thing with cryptocurrency, where it's just getting in, getting out, making a few $1,000, moving on to the next one, doing a rinse and repeat.
Right. Okay. Well, let's revisit some examples of trades that you've made correctly. One of the most famous ones that people know you for is your correct call on Bitcoin to $20,000. Now, you made that call first with me on this platform about a year and a half ago, actually. Not a year and a half ago, a year and some few months ago, back in November 2021 or October 2021. Actually, a few months before that, you were looking at the charts and you told me when Bitcoin was still in a very positive upward momentum that at some point it would fall down to $20,000. And at the time, not nobody, but a lot of people didn't believe you because you called that during a bull market, which in retrospect was counterintuitive. But I want to revisit that and talk about your thought process behind that call.
Yeah. So the thought process is this. And one of the things, and we talked about this at the beginning, is I'm always analyzing the mental psychology of the makeup of investors. And when we were talking in Dubai, when I was there with you and we were doing the interview, one of the things that I noted was that the insanity around Bitcoin. In addition, another factor was I looked back at 2017's high, and one of the interesting things about 2017's high was that the high was made and it coexisted with the launch of the futures on Bitcoin. And sure enough, in 2021, in October, when we were talking, they were just launching the futures ETF on Bitcoin. And there was so much hype around this. It was going to change. All the average investors were going to be able to jump on board, even if they didn't have crypto accounts, to be able to trade the ETF. And obviously that added to the hype. So hype was number one. I was noticing, and it made me very uncomfortable. The same sort of hype that I saw in the late 90s, early 2000s when the dot-com bubble was going to burst. The same hype we saw in housing in 2007 before it collapsed. So when you're through enough of these bubble and busts, you start to recognize the emotional attachment and exuberance, irrational exuberance, to use Greenspan's term, of what's going on, and that is a warning sign in and of itself. So that's the first thing. I was on alert. The second thing is, if we go to this chart, notice how we made new highs from the early 2021 high, but there's something called the confirmation signal. This is something I teach in my course, the Winning Trader series. But look at how this high here, all right, notice how you closed above the high and then you reversed. And then you closed above the high here again. It tried to break out again, and you never got a higher close. So the confirmation signal, and I'm just going to give you guys a crash course in this. What basically you need to do, you have to have a close above the key pivot, which was this trend line, which you saw here and here, and then you need a secondary close at a higher high. Pivot, higher high here. Notice how that never happened over here. And to me, that was telling me institutions were dumping into it. If you think about how much irrational exuberance and buying there was from the retail crowd at these highs, this Bitcoin chart should have blown through that level if the institutions were not dumping into it. The long story short, without confirmation, it was not a true breakout. And in fact, it turned out to be a classic M pattern top, right? Double top, M pattern top, which again, in technical analysis, when you learn it, you start to pay very close attention to those type of pattern tops, especially when you have negative divergences. And let me just speak about this real quick. What's the negative divergence? The negative divergence was that in April of 2021, when you were at 65,000, you had hype. When you were at the same level in price, you had basically double or triple the hype. So what I'm saying is the hype was higher, but the price was not matching that. It was a negative divergence in price. And again, you can even look at the RSI and you can see this negative divergence building as well. So these are key things that, again, it doesn't come overnight, but I always tell people 10 minutes a day of learning how to read charts. In 1 year, you will blow your mind at how good you have become. I look back at my younger self and I'm like, dude, what the heck was I thinking back then? Why did I even think I should trade back then before I learned this stuff?
Well, you've certainly come a long way from not knowing anything to the master trader that you are now, and which is the purpose of your course, to teach other people to become master traders like yourself. I always tell people, watch Gareth Soloway's interviews with me, go sign up for his course. But how much of it has to do with practice? You can watch all the courses you want. You can read all the textbooks in the world.
Right.
But unless you do it, you can't be a good trader. And I think that's what a lot of people either don't understand or don't want to accept, because a lot of people don't want to lose money and they never get into it and they lose out on the opportunities. Right. Tell us about starting off. Yeah.
And that's so important, David, because I know you play the violin, and if you said, hey guys, watch this video on how to play the violin and then you can play like me, it would be ridiculous, right? I mean, same thing with brain surgery. If they watch a video on surgery on the brain, you can't be like, oh, now I'm going to go operate on this dude's brain. So you have to look at it and say, all right, I'm going to learn it. I'm going to first watch it. I'm going to watch it maybe 3 times, and then I'm going to try to learn it and study it and put it into practice. And that's really where it comes. I was not, when I started trading back in the early, late 90s, early 2000s, I didn't have any guidance. There was no course out there that I took. And I can tell you, I lost a lot of money. Thank goodness I didn't have a lot of money back then, but to me, it was a lot when I, had a $10,000 account and I would lose 30, 40, 50%, every so often in my account by just making bad trades. If I had the ability to learn this stuff, I would have cut my learning curve by an enormous amount of time, years, and I would have at this point, I'd have so much more money than I do right now. And I think that's important for people to recognize. There's no easy shortcut. The market makes you pay, or you pay for education. The route of education is always the cheaper method. All right. And that's so important to understand.
What are some of we talked about trading rules, but rules of self-discipline, shall we put it that way, for new traders? Because, you and I have talked about some of the mistakes you've made in the past. When you first got started, you blew up $100,000 account on certain bad trades because you didn't at the time perhaps have some of the rules you have in place now.
Yeah. So, and this is so important, folks, is that number one, once you start learning, you don't jump in with a multi-million-dollar account or even a big account to yourself. You want to start with a amount in a trade where there's no emotional attachment. Remember, emotion is your enemy when it comes to trading. And so by starting small, and I often say, if I could create the perfect educational school and I had people and students in-house, I'd strap them with heart rate monitors. We'd all look at the heart rate on the screen, and I would say to them, as long as your heart does not bump up, your heart rate doesn't increase when you get in a trade, that is a proper share size of a stock or money in a cryptocurrency. The idea being is if you get in a trade and your heart rate's going nuts right away, you're too emotionally attached to that amount of money. And you have to start small. As you get more confidence, as you learn the chart, what you're naturally going to find out is that your confidence builds and you can put a little bit more money into that trade. And you'll see, obviously, the returns grow as your confidence builds. But again, it's so important. And remember this, no one went broke taking a profit. Everyone is so focused on always making the most out of every trade. What I do, I don't swing for home runs. For those of you that are baseball fans out there, think about the best home run hitters in history. They always struck out the most. And when you strike out in trading, you lose a lot of money. And
Hmm.
so I'm like, I love Wade Boggs. I grew up in Boston and then in New York, obviously, but he was a singles and doubles hitter and he got to the Hall of Fame. That's what I want to be. I'm not looking to hit home runs. I'm not looking to 10x my account overnight. I just want consistent winners at a high percentage batting average. And that's, again, how you make a real wealth. Like, that's how you're going to build millions of dollars.
All right. So I think it's important for the listeners and people who want this kind of education to understand learning from mistakes. So give us one example. We've talked about a lot of your successes for bets. Give us one example of a bet that you made in the last year that didn't work out the way that you anticipated, and explain the thought process as to, the thought process behind that trade or prediction and why it didn't go the way you expected.
Yeah, so and this is still something I struggle with today. And I think it's important to recognize is that no one ever, just because I'm considered a master trader or a pro trader, it doesn't
Hmm.
mean that I'm not continually trying to hone my skills and learn. And one of my biggest faults in my trading, and this is something I'm always actively trying to remedy, is that I see the big picture and I'm good at that. And you guys that watch my interviews, you know that I can tell you, okay, this is the likely outcome. Yes, the inflation was not going to be transitory. The markets are going to do likely this. And generally, I'm correct. My timing is something that I'm still working on as a trader. A good example of this was, I believe it was last year in early 2022. I was talking to you about how much I love China. I loved
Hmm.
the China stocks. They were beaten up at the time. And the reality of it is the viewpoint of mine was that, yes, these things are going to rip higher. Eventually, the government will get off of their crackdown on these companies. What I didn't foresee is the lockdown of COVID, and that pushed the Chinese stocks lower. Now, granted, they've all ripped higher since then, but my goal in as a pro trader is to get my timing better. And it's always something that's a work in progress, but you have to be able to see the big picture, but then figure out, okay, well, you don't want to be too early. And by the way, you see this with a lot of people, like a Peter Schiff or a Michael Burry. Like, they're telling you that these crashes are coming. And generally they're going to be right, but it's about timing it, right? If you're too early, the question is, can you stay liquid enough or do you go broke before the play actually trades out? And the biggest thing to me, and this is something I've learned, and this is the most important thing I will say, is make sure you don't put all your eggs in one basket, especially with the price of eggs these days,
Right.
right? You want to make sure that you allocate small amounts of money to different areas so that you do not kind of go boom or bust on one trade. So you can like the Chinese stocks and they can still go down. If you allocate a small percentage of your portfolio, it's not the end of the world. You want to be unemotional, analyze that chart and go from there.
Okay. Um, it's interesting you brought up China. Yes, you did call for a long China stocks trade. You didn't foresee the lockdowns because how could you? In that kind of scenario, though, would you, if you were to revisit that kind of trade again, would you hedge for unforeseeable geopolitical events?
Yeah, so the way I hedge, and that's a great question. I mean, so the way I hedge is honestly by limiting the amount that I'm putting in. So
Okay.
anytime you're investing, and this is something I did with the China trades as well, is that I'm investing a small percentage of the overall account, right? So that if that doesn't work out and it goes down, it's almost like you're hedging because you're still investing. Like, my biggest calls are gold and some of these other things, and we started to see that really play out. In fact, gold in 2022 was probably the best safe haven you could have been in, frankly. So I think the key is to hedge. For me, I'm not a big person of buying like, options to kind of offset the risk, because if I'm right 80 or 70% of the time, then all that does is take away from my gains by paying for that hedge. The way I hedge is I just invest the proper amount, and proper asset allocation is the number one thing for investors, along with discipline. And in fact, they go hand in hand together.
It's interesting. And tell us about the future now. Let's prognosticate together. Your long-term outlook for the markets. You mentioned to me that gold is likely to be the best performing asset this year relative to stocks and Bitcoin. Do you still hold that view, and why?
Yes, I do. I do. I absolutely do. So I still think gold will be the best performer. Right now, Bitcoin's leading, obviously, since the start of the year. The S&P, I don't think quite is at this point, since gold's had a pretty remarkable move to the upside. But the bottom line is this, is that you can't get away from the fact that the Fed is now keeping interest rates where they are. They're probably going to tighten a little bit more. But the bottom line is they're not going to be looking to cut until we see a massively nasty recession. So if we get in a little low level recession, which is where I think we're going to go by second half of 2023, the Fed's not going to be rushing to the aid of the market because they remember, and Powell has said this. He said that we're not going to repeat the mistakes of Volcker in the 80s. And what Volcker did was he cut rates too quickly and we saw inflation roar back. So you have to keep in mind, they already are telling you their game plan that they're going to tolerate a low level recession. If it turns into a really bad one, eventually they're going to be forced to do that. But think about where stocks are going to be. If we get in a bad recession, where are earnings going to be for 2023, 2024? And so, again, that means the stock market is going down. And obviously, for me with Bitcoin, I'm looking at the long term. I love Bitcoin. I think it's got a huge future, but you still have some stuff that have to be sussed out here in Bitcoin, including regulation, including flushing out a lot of these hands. And again, one of the biggest issues with Bitcoin I have right now is that this run in Bitcoin has almost the same hype to me that Bitcoin had at 65,000. And that is really a concern. If you look at past bear markets that finally went bullish, the first 20, 30, 40% of a move in a stock or in a market, investors were extremely hesitant. They didn't believe it because they had been hammered so badly. That's not happening with Bitcoin, and that does concern me.
Well, the recent run up we've seen since $16,000 is not as dramatic as the overall bull market in 2021, right? But how are you seeing parallels? Can you explain?
Yeah, so I think the biggest thing when you're looking at Bitcoin, right, and this is key, is that number one, if you zoom out on the chart, and we can see my chart here, that this again, it's a nice bounce, but you're still in a downtrend. You're still in an overall downtrend, and I think people have to be aware of that. In addition, you have to also remember that the Fed, this is the first bear cycle the Fed is not printing money. So the question I would say is, well, what does that mean for this cycle? Is it an elongated bear market because of that? And so these are the things that you want to pay attention to. Now, if you look here as well, in 2020 and 2018, we kind of had this same sort of almost rounded bottom like we did back we just came out of, and you did have this run up. But then look at what happened to price. It came back and basically retested that $3,500 level. And I think that again is a good guidance level for what we're going to see here. And that would just be a retest. So you're looking at going back to 16,000 or so. All right. On the other side of the coin, the negative here and why I think it could go lower is that if you don't have money being printed and the stock market does decline by as much as 25% in 2023, like I'm predicting, where is Bitcoin? Where are other asset prices that are risk on assets like Bitcoin? And I would dare say that without the Fed's printing of money, Bitcoin is still headed towards 12 to 13,000 and maybe as low as 9,000.
Without the Fed printing money. Interesting. So a lot of the run that we've seen in the Bitcoin price over the course of 2021 was because of monetary policy.
That's right. That's right. And that's been the way it has been since 2009, right? I mean, that's when QE started, and it really never stopped in a significant manner all the way through until now, because now we finally
Yeah.
have inflation that is above 2%. And I think that's something investors have to remember. One of the biggest lessons, and this is another, we talked about lessons that I learned as a trader. In 2017, I was short the market. I was down on a lot of my shorts because I was trying to fight the Fed. And everyone kept saying, don't fight the Fed, don't fight the Fed. The Fed is telling you they're printing, they're printing, they're printing. That was the right move. All right. Now, all of a sudden, they're not printing and they're sucking money out. They're reducing their balance sheet. They say they're going to keep, yet for some reason, everyone's like, oh, new bull market. Like everyone
Mhm.
wants to fight the Fed.
Yeah.
That's part of our human psychology. We want upside in the market. We want to make market. We want to make money. But just keep in mind, if you weren't supposed to fight them on the way up, are we supposed to now fight them on the way down? I would say probably not.
This is a point that's been brought up to me. It's a very good point. Bitcoin, the entire lifespan of Bitcoin and cryptocurrencies at large, cryptos have only lived through a bull market up until now. If you think about what happened post 2009, it was the longest bull market in American stock market history. And that was when Bitcoin was born. It's only basically last year that we started getting a sustained bear market. And now the big question is, what is Bitcoin and the rest of crypto is going to do in a bear stock market.
Right. And I think that's a great point. And it's not, and like you said, it's a bear market now induced by the Fed, where they're actually sucking out liquidity. And granted, the Fed will stop hiking. I think there's probably another 25 basis points, maybe two more of them. But the bottom line is that even when they go to not raising, they're not going to be going to cutting. And that's a concern, because you're not going to see that flood of liquidity. And then if all of a sudden you have stocks taking another leg lower, that sucks more liquidity out. Remember, the asset markets are tied together. People that have crypto have stocks and vice versa. And fear and panic are they're the biggest human emotions, right? That fear is going to catalyze the downside move, I would say, in Bitcoin. And that's what I'm predicting. I do think that we still have more downside on Bitcoin, unfortunately.
Right. Okay. Well, that's unfortunate news for traders of Bitcoin. Can you give us some good news? What's going to go up besides gold?
So gold, I like silver right now. Silver
Okay.
making a bullish pattern of consolidation here. I do think it has maybe a little bit of pullback, but I think silver is going to break out from this longer term trend line right here. In the short term, I actually am a big fan, and this is just a short term trade. Please understand, this is one for the next month or two, but I continue to be long natural gas down here. Natural gas, again, it was all pumped up here, and now you have this mass exodus of people and institutions down here, but you're getting to levels where it actually makes a sense to be a long trader on natural gas. So I think natural gas could have a 20% pop back from this level, maybe even 40% off of these $2.80 levels. And then also I think you start to, as we see some downside, you start to look at other markets. And I think in the past interviews, we've talked about the EWZ, which is the Brazilian stock market. Look at the macro pattern here. If you're looking for other places to invest, look at that trend line. Now, we haven't broken it yet, but if you break above this trend line on the EWZ, the Brazilian stock market ETF, this could be a major breakout. And just think about this. If this market just goes back to its highs from 2008, just its highs from 2008. Now, think about where the S&P is compared to 2008. But you're talking about a triple, a 3x on your money just to get back to those highs. So I do think, like I always say, there's always opportunities in the market. You just actually sometimes have to look a little bit harder. In bull markets, everything goes up easy. In bear markets, there's still opportunities. You got to do some research.
All right. Final question. If you were to go back to your first day of trading in your life and do everything differently, would you? Would you do
I think
anything
that's a
differently?
loaded question. I mean, listen, I think looking back at any part of my life, there's little pieces of that I would probably adjust slightly. But I do think that what I went through made me the trader that I am today.
Mm-hmm.
And I think it's kept me humble, right? I think that's part of it too. There's so many people out there that show flashy cars and all this craziness. And it's just like
Mm-hmm.
the market, I realize at this stage of my career, even at this stage, the market can take it away from me very, very quickly. And so you have to always stay humble, be always conservative, and just understand that every day is a learning experience to continue to learn going forward.
I think I read somewhere, I'm paraphrasing this quote, that you're making a mistake today, but it's not. Don't think of it as a mistake. Think of it as a learning experience for next time. Of course, there's some people that don't learn from their mistakes, but that's a separate issue. Don't be one of those people.
And that was me early on. I tell you, David, like I literally would make the same mistake 5 times before I learned, and that's why I hope people learn from me,
Well,
and then maybe they don't have to make it so many times.
maybe you didn't know it was a mistake. I mean, maybe somebody makes a back trade and part of it is luck, right? Maybe at the time when
Yeah.
you were newer, you didn't identify the techniques that weren't put in place.
Oh, and David, and you're so right about that. One of the worst things a trader can do is make a bad trade that works out. And when I say that is,
Mm.
let's say you go high, you go long on something, and it still goes up, and you think you're a genius, like in a bull market, like Dogecoin, like different things, like those set you up for future failure because it's kind of an outlier. It happens because of the time of market we're in, with the printing of money, with the government was sending checks to us, so it made so many people think they were genius traders. Which again, I'm all for being a genius trader, but you have to understand that the best traders showcase themselves in bear markets when they still make money. Most traders can't.
Well, you're still here in a bear market, and we appreciate you for that. So thank you for educating us, and good luck with your trades and for verified education. Thank you for being a part of the show. I look forward to working with you again at some point. Thank you.
Thank you, David, so much for having me. Take care.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.